Let's talk a little bit about returns. John got me, I don't know about you, but got me pretty depressed about kind of the returns of what we can look for and expect in the marketplace. This is the TSX Capped REIT Index. If you look at the red line, that's the returns from the TSX Composite Real Estate Index. If you'd invested $10,000 in 2005, you'd have just over $19,000 today. That's the lower red line. The upper red line is the value of SPIRE units. You'd have about 33% more, just almost $26,000. But the other thing to note that John talked about in his presentation was the volatility. We have not only a higher return, but we have lower volatility. And those red lines show the times where the public market responds emotionally, and you've got a loss of return as a result. We also benchmark with an organization called IPD. If you're in the real estate sector, you may be familiar. If you're not, we're in good company. You may recognize some of these names. These are all members of IPD along with us. And what we do is we take our asset data and our fund data and we submit it to IPD. IPD is a global research and data firm. They take our data and then hand it back to us, benchmarked against a peer. So one of the things that we really focus on, because we don't know what's going to happen with cap rates, really, we don't know what's going to happen with interest rates, but we can really focus on the income returns, keeping our buildings full, focusing on that income, collecting those rents. So we really focus carefully on the income return that we get from our portfolio. So if we look at the income returns for SPIRE US and SPIRE Canada, the top one is SPIRE US. That top red line is the income return that we're getting from our portfolio. The bottom green line is our peer benchmark. And then the blue squares below are the difference. And you'll see that we're getting a premium in our income return over our benchmark. So we're about 7% for our SPIRE US income return. If you look at our Canadian SPIRE Real Estate Limited Partnership, we also had a premium, but you'll notice that there's a little bit of a dip there in 2012. We had one building, a large single-tenant building, where we had to take that building back. We had to reposition it. We had to release it. So we had a dip in our income. But one of the benefits of having a diversified portfolio is that we can absorb that. And you'll see that we're already tracking again with higher than the benchmark in terms of the income return. Looking at total return now, not just the income return, but if you look at the top SPIRE Real Estate Limited Partnership, since inception, 2010, almost 11% compound return. 1 year, last year we had a 12.9% return. The distribution trailing 12 months is 5.9%. The bottom section talks about SPIRE Real Estate. Since inception, which goes back to 2005, we're 9.6% compound return. Last year, return of 8.3%, and a trailing yield of 5.9% for distributions. Let me talk just briefly about risk management strategies. What is our approach to managing the risk? Because real estate does have risks. We focus on major markets. Why do we focus on major markets? There's more deal velocity. There's more buyers in major markets. There's only a few major markets in Canada. There's more major markets in the US. Major markets gives us, when we want to sell asset, there's more buyers. When we want tenants, there's more tenants. When markets get depressed, there's a lower drop in value and a quicker recovery. Demonstrated over a long history of time, major markets work. Functional utility, not only do we look at the location, but we also look at the asset. And the asset, we want to make sure that there's good functional utility. If that tenant goes dark or that tenant moves out, what's the likelihood of finding another tenant? How easily are we going to be able to replace that tenant? So functional utility is really an important factor. Retail, are you on the right side of the street? Are you in the right traffic patterns? Warehouse, have you got the right ceiling height? Have you got the right number of dock doors? Have you got the right number of turning radiuses? Sort of things that if you don't know the industry, you can make bad purchases. If you know the industry, you know what to look for. Functional utility is really important for us. Occupancy, because we focus so much on cash flow and income returns, if we keep our buildings full and we look after our tenants with great property managers, with good leasing agents, paying attention as asset managers, we can keep our buildings full, and that really over the long term contributes positively to our returns. Debt. We want to have conservative leverage on our assets because you never know when you're going to need cash. If there's a downturn in the market or there's a building that goes dark and you need to reposition an asset, you want to have good cash reserves in the real estate industry, and having low debt, conservative debt, staggered debt so that you can move with the markets. Those are important things to take into consideration. And cash flow. You saw the IPD, focus on income, cash flow. We really pay attention to how do we optimize the cash flow from our assets? How do we reposition? How do we work with our tenants? How do we work with our leasing brokers and our property managers to maximize and optimize the cash flow? Strategic partnerships, an important part and a growing part of our business, both for our income portfolios but also for our value add portfolios. I mentioned this seniors housing, BRIA, the Century Group, established, well-respected specialists in that industry. Partnering with them shoulder to shoulder is how we're going to grow and operate in that senior sector. Venterra Living, John Foresti is here with us this evening, been a great partner for us in the multifamily sector. They're specialists in the multifamily sector in the South and Southeast U.S. That's all they do. They do that very, very well. They're a great partner for us to have. In the value add sector, PC Urban on commercial, Grosvenor and Port on the multifamily residential, great partners. We don't have to be the experts in that area. We just have to know how to maintain and manage and work with those partners. What are we looking for in a partner? Focused and specialized expertise, pipeline of opportunities. If you're really good in a specific sector, you attract opportunities. And having great partners means that they're seeing deals that aren't on the market. They're seeing deals that are private and off market. They're getting first look, and they're getting looks at all of those kind of opportunities. That's an important part of having good partners. Aligned interests. We want to have capital at risk with our partners. In the same way that we invest our capital alongside our investors, we want our partners to invest their capital alongside our capital. So aligned interests with capital at risk. A proven track record. We don't want a partner coming to us and saying, I've got this idea that I'd like to build a building over in Timbuktu. We want to know that they've operated in that market, that they know exactly what they're doing, and they've got a proven track record. And we want transparency and accountability. We want open books. We want to see what's going on. We want to talk regularly and communicate. We are active asset managers with our partners. Let me talk very briefly about one of our partners, Venterra Realty. Why do we like Venterra? Venterra really looks at it from the top down. They look at the markets. They identified the South Southeast many years ago, said that's where the job growth is. That's states where there's low taxation. That's where the jobs are growing. That's where the population is growing. That's where we want to be. That's been a great call. They're owner-operated investments. They do their own due diligence. They do their own property management. They do their own capital improvements. So they're hands-on, not only vertically integrated, but they are also investing their own capital in each of the deals. They're a long-term business that sees eye to eye with what we're wanting to accomplish and achieve. And they also achieve best-in-class results and have a proven track record of a long period of time. We're currently invested in 50 multifamily investments and over 13,000 units with them. Great partner. Let me give you one example. This is a property that we acquired, that Venterra acquired. We invested in right at the beginning, 2007. We were just getting to know each other. It was 3 multifamily apartments in Houston, 738 units, B assets, value add strategy, improve the units, grow the rents. We sold that asset in 2016, earlier this year, and achieved an IRR of 18% compounded over that 10-year period. That's a good return. What's significant about it is if we look at what happened between 2007 and 2016 is you had that great recession in the US. You also had Hurricane Katrina. You also had B quality asset that needed to have rehab work and be maintained over that period of time. Older assets require more work. So included in all of that and still achieving an 18% return is a good outcome. We have not lost money with Venterra or with our joint venture partners. Strategic partners, Grosvenor. I talked a bit about Grosvenor earlier. I'm not going to go into them, but we've started with the first 12 deals. We've expanded that, and we're now added 2 more deals. When we started off, we made a $55 million commitment, 55 from our portion, 55 from each of the other 2 partners. We've committed that. We're now into our next tranche, and SPIRE Value Add is an active participant in that tranche. What makes SPIRE different? And I'm going to conclude my section and then hand it over to Mark. A few things. I think we've got proprietary products for our clients with close to $1 billion of capital. We've been doing this for a while. We love it. I think we're pretty good at what we're doing and what we've achieved over an extended period of time. We've got a track record of income return and total return with less volatility than the public markets. We've got a wide diversification of products, both location and asset type, which helps mitigate risk. Management is invested with capital alongside our investors. I think we've got, amongst our management, over $30 million of our own money shoulder to shoulder with investors. So we believe we're drinking the Kool-Aid. We like this as an asset class. It's important for us in our investment strategy. And we're engaged as an asset management team. You're going to find when Mark comes up here, we're passionate about what we do. We love what we do. We think we've got the best jobs in the world. We sleep well at night. And we are comfortable recommending our SPIRE investments to our family members, to our friends. And that's it. We want that to continue to be an important part of our lives. And we've got quality partnerships and relationships. We have demonstrated the ability not only to attract, but also to sustain and maintain partnerships, which is a good growth strategy for us going forward.